This video will go over various GAAP concepts. In accounting, you need to know what GAAP stands for and what it means. GAAP stands for Generally Accepted Accounting Principle. It is a set of rules and standards controlled by the Financial Standards Board, FASB, a private, non-profit, independent organization. The FASB created GAAP as guidelines that company accountants should follow. None of this involves the government. Now, the government wants companies to follow GAAP. They created the SEC, Securities and Exchange Commission. The agency will enforce public companies, which are companies listed on the stock exchange, to follow GAAP. Think of the SEC as the watchdog of the government. Internationally, companies follow IFRS for International Financial Reporting Standards. That's the counterpart to GAAP. IFRS is managed by the IASB, International Accounting Standards Board. Just like the Financial Standards Board, the FASB governs GAAP. You will often see job boards references GAAP. Here on the staff accountant position, it requires ensuring compliance with GAAP. Another position requires good working knowledge of GAAP. Under GAAP, there are some specific concepts. First, business entity concepts. Basically, do not intermingle business activities and records with personal activities and records. Reason is to keep the integrity of the business as a separate legal entity, to keep track of the business financial performance accurately, and to have the correct taxable result, and also to be auditable. If things are combined between personal and business, all of this becomes extremely difficult and it lacks integrity of the business as a separate legal entity. Time period concept says that companies must divide their financial activities over a standard period of time, which is usually monthly, quarterly, or annually. If they don't do that, how will shareholders know the performance of the company they invested in? Companies cannot just report financial performance whenever they feel like it. A standard period of time must be selected and kept consistently. A 12-month period selected by the company is called a fiscal year. It could begin on any month. For example, Macy's fiscal year begins February 1st and ends January 31st. This is typical for retailers who do not end the fiscal year on December 31st when they are so busy with the holiday season. The cost concept says to record in the accounting books at the cost of purchase, not at the market value, not at what you think it is worth, not at the opinion of the government. It must be at the purchased cost. Let's take a look at the example. Aaron Publishers purchased a building on February 20th for $150,000. Other amounts related to this purchase are shown below. Price listed by the seller on January 1st, $160,000. That's the listed price, so that's the opinion of the seller of how much it's worth. Aaron Publishers' initial offer to buy on January 31st. So a month later, Aaron offered initially $140,000. That's how much Aaron thinks it should be worth. Estimated selling price a year later, $220,000. That is the estimated amount of the value 1 year later. Assessed value for property taxes, December 31st, 190,000. That's the opinion of the government of the value of the property so that it could assess the property taxes. Now, what is the amount that it should be recorded? That's the purchase price. On February 20th, $150,000. That's the cost. The reason is because in accounting, it has to be objective. There must be proof and evidence, which is the invoiced amount. That is the final agreed upon amount. Last concept here is the unit measure concept. Accounting convention is that financial data should be recorded with a common unit of measure. For example, as the US dollar, pound, euro, yen, or any other currency. If a transaction involves receipts or payments in a different currency, the amount is then converted to the home currency used by the organization before being recorded.